Right, so today we're going to spend 2 lectures looking at IFRS 5. IFRS 5, IFRS 5. IFRS 5 deals with 2 things. It deals with non-current assets held for sale. What happens when I have a non-current asset like PPE, property, traffic today? It's irritating. Why are you going at 40 kilometers an hour when I want to get somewhere? It's frustrating, eh? I know.
Like this, it's like, hurry up! And I was like stuck behind like for 2 kilometers until eventually there was like an opening. I could finally get around.
Gosh. All right, so today we're dealing with IFRS 5. IFRS 5 deals with 2 things, or we're going to spend 2 weeks looking at IFRS 5. It deals with 2 things. It deals with non-current assets held for sale, PPE, for example. When we're looking at non-current assets held for sale, we're looking at 2 things. We're looking at reclassify, because we need to move from non-current assets to current assets. Do you agree? If I have a non-current asset that I'm holding to sell, then I need to reclassify it. It's no longer non-current, it's now current, and so I need to move it on my financial position from the one to the other. And I also need to remeasure. You know, PPE we carry at cost less depreciation, isn't it? But if I'm not using it anymore, if my intention is to sell it, I need to remeasure it. And my measurement changes. An asset that I'm using is measured differently to an asset that I'm holding to sell or planning to sell. So IFRS 5 deals with non-current assets held for sale, which I need to reclassify and remeasure. We're going to look at that today. It also deals with something called disposal groups. No, not disposal groups, I'm wrong. Discontinued operations. Discontinued operations. And discontinued operations are sections of your business that you have sold or are planning to sell or have shut down. And there is P&L disclosure for discontinued operations, because what I want to do is I want to tell my shareholders how much sales and profit there is from continuing operations that are still going to be here next year and the year after, and how much sales and profit are going to stop because they are discontinued operations, and so therefore next year we won't expect to see those. So you'll see, or what you can see, is that the one side or the one element has to do with SFP, the other side has to do with P&L. And we're going to do this in 2 lectures. Today we're going to do non-current assets held for sale, and then next week we're going to do discontinued operations. But both of these are dealt with under IFRS 5, because essentially IFRS 5 is dealing with discontinuations or sales when we have long-term assets that we are disposing of or have disposed of or are planning to dispose of. Okay, so non-current assets held for sale. Definition is essentially your non-current assets. What do we have in non-current assets? PPE, intangibles, investment property, investments. Do you agree? Non-current assets on my statement of financial position. PPE, intangibles, investment property, and investments in shares. Those are your non-current assets. The definition of non-current assets held for sale is non-current assets that you're intending to sell. And in order to recognize, the second step, I may as well do it in red, in order to recognize an asset, a non-current asset, as a non-current asset held for sale, there's a number of criteria that need to be met. Yeah? So the following criteria needs to be met. It's there in your notes. It's quite a few of them. But the main ones are management intention. Management must have an intention to sell the asset. Asset not in use, ready to sell immediately. So if I, for example, have a machine and I'm still using the machine, but I think I might want to sell it. It doesn't meet this criteria, isn't it? I'm still using it. It has to stay in PPE. It has to be an asset that I'm not using anymore. I have a spare car that I don't use. It's sitting in my driveway. Or sometimes you see those cars at shopping centers. They just go and park them at the shopping center all day with the for sale sign. I have a car. I'm not using it. It's sitting in my driveway. It's sitting at the back of my garage. If somebody wanted to buy it, they could come immediately. They could call me and come immediately, and I would sell it to them. Yeah. So I have to have management intention, and the asset must not be in use. I think of all of the criteria, that one is probably the most important. There's a couple more that are important. The third ones have to do with price and marketing and a buyer. You need to be actively looking for a buyer. You need to have marketed or be marketing this asset for sale. You need to have set a fair price at which to sell it. It doesn't help that you say, I have this car and I really want to sell it, but now you're trying to sell it for too high a price. It will never sell, isn't it? Then you have to question, is management intention really to sell that asset? So if you look at your conditions, you'll see that your first condition says management is committed to a plan to sell. The asset is available for sale, and the next condition says an active program to locate a buyer has been initiated. We're going to skip the next one. The asset is being actively marketed for sale at a sales price which is reasonable. Actions to complete indicate that it won't be withdrawn. The fourth one, and probably another important one, is the sale must be within 12 months. You're expecting a sale within 12 months with no withdrawal. So we really are expecting to be able to sell this asset in the next year. Why? Because we're at year end, isn't it? And so when we do financial statements at year end, it needs to be happening in the next year. If it's not happening in the next year, it must stay as non-current, isn't it? Because current is something that's going to happen in the next 12 months. So it needs to be happening within the next 12 months, and there needs to be no chance that you will withdraw your intention to sell that asset. So non-current asset held for sale is a non-current asset, PPE, investment property, intangibles, and investments, where we have the intention to sell. How do I know I have this intention to sell? I've got to meet these criteria. These criteria are the recognition criteria. Recognition criteria up to now, we've always referred to framework, isn't it? We always say probable, measurable, probable, measurable. But for non-current assets held for sale, that's your recognition criteria. Your recognition criteria includes that there must be an intention to sell, that the asset can't be being used anymore, that we need to have looking for a buyer and set a price, and that the sale is going to happen within the next 12 months. For your purposes, they will almost always tell you this is when the criteria is met. But when you get to honors, they just give you big stories, and you have to figure it out, isn't it? But a big one for this is this asset not being used. It has to be an asset that's not being used. If an asset's being used, it must stay in PPE and it must be depreciated. All right, so let's look at measurement then. Initial measurement. The first thing that happens, of course, is before we measure, and let me put it up here perhaps. Do I have your, I can go up a bit. The first thing that happens, which is something that normally doesn't happen, is the classification, reclassify. And reclassify is just a journal where we're going to debit current assets and credit non-current assets. Yeah, it's just the reclassification. Agreed? I need to move this current asset, this non-current asset that was PPE or investment property or investments, and I need to move it from the top of my financial position down to the bottom. Yeah. So this is an important extra step. It's the first step. Once we've met criteria, so once this criteria is met, my non-current asset is no longer a non-current asset, it's now a current asset because of this 12 months story over here. And so because of that, I need to reclassify it and I need to move it from non-current to current. Once I've reclassified it, I then need to measure it. Yeah? How does measurement work? Measurement for non-current assets held for sale is at the lower of carrying amount or fair value less costs to sell. And it makes sense, isn't it? Because think of the definition of an asset. It's a resource which you control from which there will be future economic benefits, isn't it? What are the future economic benefits if I'm selling an asset? It's what I'm selling it for, isn't it? These are the future economic benefits if I'm selling the asset. Fair value less costs to sell. So therefore, when I measure non-current assets held for sale, I measure it at the lower of carrying amount, what I was carrying it at, and fair value less costs to sell. I also at this stage don't want to be creating profit, isn't it, by putting numbers in. So I don't want to create profit. If I do sell it for above carrying amount, then when I sell it, then the number is real, isn't it? At this stage, I'm just remeasuring. But at the same time, if the carrying amount is 100, but I can only sell it for 80, I need to drop it, isn't it? Because that 20 doesn't meet asset definition then. All right, initial measurement at the lower of. Then subsequent measurement, and I mean an important thing to put here, I must put it in. We stop depreciation. We are no longer using the asset. It isn't even in PPE anymore. So there is no more depreciation. I measure it at that, and it stays that, isn't it? For 6 months, for 8 months, for 4 months, however long before I sell it. So I move it, I measure it, and it stays that. I stop depreciating it. Then I have subsequent measurement. Subsequent measurement will happen at year end. So it could be that I have a PPE item that halfway through the year met criteria. So what do I need to do? I need to depreciate it up to that point, isn't it? Then I need to transfer it, and then I need to remeasure it. Yeah? Step 1, 2, 3. Yeah? So depreciate, transfer, remeasure. Then at year end, if the asset is still there, I haven't sold it yet, I check this measurement again. Again, at lower of carrying amount or fair value less costs to sell. And over here, I then could have a further impairment, yeah, or what I could also have, and when we did impairment, we looked at this, I could also have an impairment reversal. An impairment reversal. So let me just take you through a quick example of how this would look, sort of very high level, and then we're going to practice some of the examples that are in the study guide. So there's one more thing that I need to tell you. Over here with this measurement, there's an exception. There's an exception here with the measurement. The exception here with the measurement is assets carried at fair value. So which are the assets that I carry at fair value? Investment property and investments. Do you agree? Investment property and investments are carried at fair value. Yeah. So with investment property and investments, I will still reclassify. So I'm still going to move them out of non-current assets held for sale, but I'm not going to measure them at fair value less costs to sell. They're already at fair value and they stay at fair value. Yeah. So with investment property and investments, I will reclassify it to non-current, from non-current to current, but I won't do this remeasurement because they're already at fair value. Do you agree? So they're already carried at fair value. I don't have to remeasure. All right. Let's have a look at an example. So let's assume that I had PPE at beginning of year, and it had a value of 1,000. Let's assume that depreciation is 20% reducing balance, and that halfway through the year, criteria is met. So the first step, step 1, is to then depreciate to get the carrying amount at that date. Yeah. So at 20% per annum, it would be 200. Halfway through the year, so 20% for 6 months, my depreciation is 100, and then my carrying amount is 900. Step 1, to get me to the date where the criteria is met. Step 2 then would be my journal. My journal entry is to debit non-current assets held for sale, 900, and to credit my PPE, 900. Just be careful, I do this journal like this, and I also didn't even tell you cost. But what we actually need to do here, let me put it like this. What we actually need to do here is we need to credit cost and debit ACDEP. Isn't it? I don't know how much was cost and how much was ACDEP, but you actually, when you're doing the journal entry, remember we have a cost account and an accumulated depreciation account, you have to do the two pieces. So let's assume if the original cost of the asset had been 2,000, it would be a credit of 2,000 and a debit of 1,100 to get the 900, okay? So that's journal 2. Then, or step 2. So step 1, depreciate the asset up to the date. Step 2, reclassify it, move it. Step 3 then is to measure at the lower of carrying amount or fair value less costs to sell. Let's assume that fair value less costs to sell for this asset was 700. So now what I need to do is I need to therefore do an impairment of 200. Because remember, I brought in 900. My fair value less costs is 700. I will have an impairment of 200 to get me to the 700. Yeah? Step 3. Then let's assume year end comes around. And when year end comes around, I check fair value again at year end. And let's assume at year end, fair value less costs is 800. Now I can reverse impairment, isn't it? Reverse impairment, and how much impairment can I reverse? I can only reverse a maximum of 200, isn't it? So I can reverse impairment of 100. Let me put 2 more scenarios on there. So let me actually move this way a bit. If I had said to you that at year end fair value less costs was 600, then I would have a further impairment of 100, isn't it? So then I would have a 100 impairment, where in that case it was a reversal of impairment. Yeah. If I said to you that at year end fair value less costs to sell was, let's assume it was 1,000. The maximum that I can reverse is 200. I can't go back to 1,000, isn't it, from 700? Because remember, I'm sitting at 700. So if I'm sitting at 700 and it goes up to 800, I can reverse 100. If I'm sitting at 700, it goes down to 600, I impair a further 100. If I'm sitting at 700 and it goes up to 1,000, I can't go back up to 1,000 because that's a 300 reversal, and the maximum amount that I can reverse is a 200 maximum reversal. Yeah? All right, so this is an example then of the steps when we have a non-current asset held for sale. Depreciate up to the date. Then transfer it to non-current assets held for sale. Then remeasure it at the lower of 900, which is carrying amount, or fair value less costs, which is 700. And at this stage, you'd have an impairment. Then at year end, check fair value less costs again and measure again. In this case, a reversal of impairment or a further impairment might arise. Right? Okay, let's have a look at some of the examples in your study guide. The first example is example 4. What's example 5? No, I don't want example 5. Okay. The first example is example 4. It's on page 198. And I want you to do those 4 steps for me. Well, you won't be able to do step 4. The 3 steps for me for this for this asset as practice. So Chuck has PPE. PPE had a cost of 400,000 Rand. And a historical cost carrying amount of 320,000 Rand. It's depreciated 10% per annum, straight line, and they have a December year end. So the cost was 400,000 Rand. At beginning of year, carrying amount was 320,000 Rand. Yeah? So if we just look at the information, cost of that, carrying amount of this at beginning of year. It's depreciated 10% straight line. They, at 30 June, halfway through the year, management decided to dispose of the asset, and all the criteria are met. Remember I said to you they would usually tell you. The fair value of the item is 290, and direct costs to sell are 15. All right, so I want you to do steps 1, 2, and 3 for me. So I want you to depreciate the asset up to the date the criteria is met, because up to there it's PPE. Then transfer it to non-current assets held for sale, and then remeasure it and check impairment at that date. Okay. So it should have been quite simple to do, right? So what they say is that the item would need to be reclassified. So you first need to calculate what amount would go through, and they worked out depreciation of 20. Is that what you worked out? Depreciation of 20. So therefore the item or the amount that would be reclassified would be 300,000. So 300,000, you would do a journal entry, debit, non-current assets held for sale, 300,000, credit, PPE cost, 400, debit, PPE accumulated depreciation, 100. Yeah? So that would be that entry. Then, when you check fair value less costs to sell, it works out to 275. We had a carrying amount of 300. We have fair value less costs to sell of 275. We therefore have an impairment of 25, an impairment loss. There's a note. I want to show you what that note looks like before we look at disposal groups. The note is actually a note. No, I don't want that one. I think it's this one. No, it probably was that one. Here it is. It's on page 218, 218. It's an example that we're going to look at next week because it's an example that has a discontinued operation. But part of discontinued operations would include assets that we are now planning to sell, isn't it? If I've decided to discontinue an operation. So this is the note. They like to ask these notes. They ask for the non-current assets held for sale note or the disposal group note. I'm going to talk to you about what a disposal group is. What you can see happens in the note is, first of all, a story. Yeah. So this is the note. You need to flag it. And the first thing that's in the note is the story, is descriptive disclosure. A decision was taken to dispose of property and plant due to the fact that a branch incurred losses for the past 2 years. It was taken in March 2010. So they talk about what's happened and when the decision was made. At that stage, there was an approval of a detailed formal disposal plan for the discontinuance of the East London branch. The plan regarding a piecemeal sale of the assets was at completion stage at 30 September 2010. So the decision was made in March, but all the criteria basically was met in September. Do you agree? That's more or less where it says. And at that stage, there was no realistic possibility of withdrawal. So that's where the criteria is met. It's expected that the assets will be sold for cash, and the disposal will be completed by 28 February 11. Right, so it's just the story. That story will be in your notes, isn't it? So when you see that they ask for this note, and as you're reading the question, you see this information, you're going to copy it. Then, so that's descriptive. The second piece of the note is then the balances. The balances that are in non-current assets held for sale. In this case, there are two non-current assets held for sale. There is a property and there is plant. Yeah. Two of them. And remember, these balances are the balances that are sitting at year end, the year end balances. And these year end balances would be at the lower of carrying amount or fair value less costs to sell. And then the third thing that you need to put in, so the first piece is descriptive, the second piece is the balances, and the third piece that you're going to put in is about the impairment. If there was an impairment write-off or a reversal or whatever it was, in this case, an impairment loss of 15,000 was recognized on the initial classification of the property and as held for sale, and the amount is included under loss on the face of the P&L. We're going to talk about where these impairment amounts land up if it's a discontinued operation. The assets are part of the Eastern Cape geographical segment. This is part of segment reporting. We're going to do segment reporting a bit later. No, we do it in FAC3702, in fact, not in this module. A little bit of segment reporting. Okay, so you can see the note. It would be worth about 8 marks. Why? Because you have to go through that step first. Hey, you have to depreciate, work out fair value, work out impairment. So you have to go through all those steps, and then you have to write out this lovely note. Yeah, this is the note for non-current assets held for sale. In this case, there are 2 assets. Sometimes it's 1 asset. It depends. Okay. So then I said to you that there's an additional thing called a disposal group. Put it in the wrong place. Let me just fix where it is, otherwise then it just gets confusing. Actually, let me put it. I'm going to put it here. Okay, example 5, if you wanted to have a look at example 5, I see I did put it on here. Example 5 is about an investment property that is being reclassified. And the solution just is a little story about the fact that because it's an investment property and it's carried at fair value, we don't measure it at fair value less costs. It stays at fair value. So that's the only thing that's here. It says that investment properties fall outside of the measurement requirements of IFRS 5, and so therefore they will be carried at fair value, and the fair value was 510, not at fair value less costs, which would have been 510 less 15. So not at fair value less costs, just at fair value. Why? Because investment properties fall outside of the scope of measurement requirements of IFRS 5. Okay, but it's not a difficult thing, so I don't think we need to look at it in any more detail. All right, disposal groups. Sometimes it happens that you are selling assets as a group of assets. Yeah? So let me give you just a quick example. A disposal group, if I do a definition, is a group of assets disposed of or being disposed of in a single transaction. So let's assume that I sold a branch, or I closed down a branch. And now I'm selling those assets, and somebody has come and said they'll take all of them. Yeah? Or let's assume that I've decided to sell my property, my holiday home at the coast, and somebody has come along and they've said, I'll buy the property, I'll take all the furnishings and everything, and I'll even take your car. So then I have a holiday home that I can just fly down to, isn't it? All your assets being sold in one transaction. This is the problem. The problem is that because I have a single transaction, I therefore have one price. One price. So what I could have is I could have various assets. Let me use the example that I just gave you. I have a property. No, let's actually call it what it is. I have land, and I have a building, and I have furniture, and I have a vehicle. And all these assets are being sold for one price. So let's assume, let's assume that my land is worth 2 million, my property is worth another, that's a bit extreme, eh? Let's assume my land is worth 1 million, my house is worth 2, my furniture, let's assume my furniture is worth, 100,000 rand, and let's assume I have a car that's worth 200,000 rand. So I have assets worth 3. Yeah? And somebody wants to buy them, and they're going to buy them from me, fair value less costs, at 3 million. So I have an impairment, isn't it? And the impairment is 300. Now I have to figure out how to allocate this impairment. Because if you remember that note, the note will say land this much, whatever this much, isn't it? I have to have numbers for these items over here. Let me just move them across here a little bit. I have numbers for those items that need to appear in my note. So my note that I need to put into my financial statements needs to add up to 3 million, not to 3.3 million, isn't it? So what I have to do with this impairment is I have to allocate it among those items. Yeah? And you must just be very careful, because when we allocate impairments, what did I do there now? I just wanted to move that down so that I could move it. You have to be careful, because when you allocate impairments, we do not allocate impairments to, and I'm going to put here, I should have not been writing in red, because then I could put it in red. We do not allocate impairments to, so this here needs to be allocated. We do not allocate impairments to assets carried at fair value. We also don't allocate impairment to current assets. And we also don't allocate impairments to liabilities. And do you agree it makes sense? Because assets carried at fair value are already at fair value. So if there was a decrease in value, we would already have taken that into account, isn't it? Current assets are already, in terms of their standards, less provisions for doubtful debts, less obsolescence, they already carried at fair value. And liabilities, we don't remeasure to fair value. We don't carry liabilities at impairment. We don't consider impairment of liabilities. And so therefore, we do not allocate impairment to those assets. So if my group, in this case, my group is just PPE items, isn't it? But if my group of assets was not PPE items, then I wouldn't allocate that value of assets. All right. But otherwise, the steps for the disposal group are identical. And we're going to work through an example so that you can see how that works. The example is on page 200. 200. So it says, Candy decided to dispose of a disposal group within the next year, and the decision was taken at 30, or the date, the criteria date is 30 September 2010. All the requirements have been met, and consequently the group is classified as held for sale. The carrying amounts of the items included are as follows. Land at 1 January, at beginning of year. Carrying amount 150. Building at 1 January. Carrying amount 520. We need to depreciate it for 9 months. Do you agree? Plant. Carrying amount at beginning of year. I need to depreciate plant for 9 months. Inventories. Carrying amount of 50. At 30 September, the net realizable value was 45. Inventories are carried at the lower of cost or net realizable value, isn't it? So inventories, I'm going to put in at 45, which is net realizable value at that date. Payables of 25 and a share investment that had a fair value of 110. So do you agree? Those are my lists of assets. You're going to do a calculation. Where's my thing? That looks like that. Yeah? Land, building, plant, inventories, payables, investments. Remember that payables is a minus, say it's a liability, and you're going to get 954. Okay? So just as a check for you. Then you're going to say 954 is the total value of my disposal group. Carrying amount. The fair value less disposal costs at initial recognition was 980, less costs commission of 50, CGT of 20. We don't work after tax. Do you agree? All my numbers are pre-tax. PPE is a pre-tax number. It's not an after-tax number. Where is the tax for PPE? It's sitting in deferred tax, isn't it? So I don't put tax in. I don't mix up my stories. It's either all before tax or it's all after tax, but it's... So therefore, this is my fair value less costs to sell, 980 less 50. Yeah? So you're going to do a calc that's going to look like this for me. All the assets, land, etc., 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 and you're going to have carrying amount at 30 September. Then you're going to have fair value less costs. It's going to have a value here. I think it was 980 less 50, isn't it? There. Then you're going to have a middle column, which will be your impairment. There. So that minus this will give you that. Do you agree? You're going to allocate this impairment only to PPE and intangibles, isn't it? You're not going to allocate to inventory. Inventory is already at net realizable value. You're not going to allocate to payables because payables are liabilities. You're not going to allocate to investments because investments are carried at fair value. You're going to allocate to the other three assets, and you're going to allocate it in proportion. In proportion. Okay, so this is what I want you to do for that calculation. I want you to do all of those assets. I think it was land, building, plant, inventory, creditors, investment. You're going to work out the carrying amounts. I think this number was 954 as a check. Then you're going to put in fair value less costs. So this will be step 1. Let me actually do it in a different color. This here is step 1, is to complete this. Then This is step 2, to work out fair value less costs. Step 3 is to work out impairment, which will be a balancing figure. Then step 4 is to allocate the impairment. And then step 5 is then to get my values of my assets. Agree? First work out what the values are at carrying amounts are at 30 September. Then work out fair value less costs. Then work out impairment. Then allocate the impairment. Remember what I said, inventory doesn't get, creditors doesn't get, investments doesn't get. They won't get impairment. The rest will get in proportion. Allocate impairment and then push the numbers across. And these numbers here should tie up to that number. These numbers here are the numbers that will then appear in your note. Okay, I'm going to leave you to do that. I'm going to go make a copy of the paper I want you to practice. Did you get the 954? You did? Okay. In your study guides, if you go all the way to example 9 on page 205, it's this example. I don't know, it starts at 6 and then what are they, like extend it. And if you go to page 205, that's where this example is. And if you look, they get the 954. Then they've got the 930, which was fair value less costs to sell. So these were the steps. Step 1 to get to that. Step 2 was that. Impairment is 24. Allocate the impairment. Nothing to inventories, nothing to payables, nothing to investments, because investments are at fair value, the other ones are current, they're not non-current. So then we allocate the 24 between land, building and plant in that proportion. Did you get those numbers? Add the 3 together and use the proportions. 4, 3, 6, 9, 14, 3, 8, 8, 5, 2, 4, 3. So therefore carrying amount after impairment loss is these numbers, and these numbers then would be what would appear in your note. Yeah. I want to show you the, it's a reversal. No, is that a reversal? Yeah, that's a reversal. I'm going to come to the reversals now. I wanted to show you a disposal group. Here. So here's a note for a disposal group. What you'll see is that it's very similar to the note for non-current assets held for sale. It just has a different heading, right? So this is a disposal group note. The disposal group note again starts with descriptive disclosure of what happened and why we decided to change. It then has the list of assets and liabilities that make up the disposal group. In our case, we would have had land, property, plant, inventory, and investments, isn't it, at the top? And then we would have had liabilities at the bottom. Because remember, in your financial position, you're going to have the current assets together and the current liability together. Hey, we're not going to split them off. So there's my numbers for the disposal group, and then at the bottom here a little bit of a story about the impairment loss that was recognized. Yeah. So that's the disclosure, page 205. No, sorry, this disclosure, page 224. And next week we're going to come and look at these two examples, the ones with the disclosure, because they have a discontinued operation, and then as part of the discontinued operation we're also going to look at the assets that were disposed of. All right, so a non-current asset held for sale, if we just go back to the very beginning. A non-current asset held for sale is an asset that meets the criteria to be reclassified and remeasured. Yeah. There are 5 steps, or 4 steps. Depreciate the assets up to the date of the criteria, reclassify it, measure it, remeasure it at lower of carrying amount of fair value less costs to sell. It would give you an impairment. At your end, measure again. Further impairment, reversal of impairment, or nothing. Yeah. Then we looked at disposal groups. It's where a group of assets will be sold in a single transaction. Therefore, there's one price. And that was our issue, wasn't it? It was the fact that there was one price. It doesn't pick up. And so the problem with the one price is that there's an impairment amount that we now need to allocate. Yeah? So the whole issue is this impairment and how to allocate this impairment because of the one price. So how do we allocate the impairment? We allocate it apportioned to the assets that should get impairment, and those are just my non-currents, isn't it? It's just property, PPE, and intangibles, because investments doesn't get, investment property doesn't get. They carry that fair value. All my current assets don't get, all my liabilities don't get. Yeah. So no allocation to those, so everything else would get. And then we looked at this example. Now, okay, just before that, I want to talk to you about something that could happen, which is a transfer back to PPE. Remember that I said to you, to PPE or intangibles, I said to you, so in essence what we're looking at is a change of plan. I said to you in the beginning that the criteria is strict. We need to really, really be serious about selling this property, isn't it? So let's imagine that story I gave you that I'm selling my holiday home in the Cape. Let's assume that something happens and I land a really good job. I was unemployed, I had to sell that property, but something happens and then I land this really good job or I get a good contract. And now I decide I don't have to sell my property anymore, isn't it? There needs to be some event that happens that makes you change your plan. But when there is a change in plan, everything goes backwards, isn't it? It goes backwards. But the rule when things go backwards, when I go back to PPE and intangibles, the rule is that I go back at the lower of what the carrying amount would have been. And you remember that when we did impairment, isn't it? When we did impairment, we had to work out what the carrying amount would have been so that we can reverse the impairment. Yeah? I go back to the lower of what the carrying amount would have been, or recoverable amount. So I go back really in terms of impairment statement, yeah, to the lower of what carrying amount would have been or recoverable amount. That's what I go back as. I've never really seen this asked, especially at this level. There are no exam questions or anything like that, but there is an example. The example, sorry, let me just let you do that. So when I transfer back to PPE or intangibles because of a change in the plan, it goes back to PPE or intangibles at the lower of what the carrying amount would have been or recoverable amount. So the example is example 11. It's page 208. 208. Monty had classified a patent as held for sale on the 30th of June 2010, which was the year end. And the patent had a carrying amount and fair value less costs of 960 at year end. And the original cost of 1.6 and amortization is 20% straight line with no residual. Due to a change in patent rights, you can see this was something, an event, isn't it? Really outside of our control. There was an event that occurred, there was a change in patent rights promulgated on the 1st of April, and they decided no longer to dispose of this patent. And subsequently, the asset had to be reclassified from non-current assets held for sale back to intangibles, isn't it? The recoverable amount of the asset under consideration at that date was 700,000 Rand. So what I need to do is I need to work out at 1 April 2011, if I had never transferred this patent, which I transferred on that date, and at that date it had a carrying amount of this, what would the carrying amount have been at April 11? Yeah. So I'm not going to do the calcs, we're just going to follow their calcs. So at June 2010, the carrying amount was 960, and I would have depreciated for 9 months, 6 months up to December, and then January, February, March up to the 1st of April. Yeah, 6 plus 9, 9 months. And amortization is at 20% straight line, so it's 20% on 1.6 million. 20% on cost, straight line depreciation for 9 months would have been 240. So the carrying amount, if I had never done anything with this asset, the carrying amount would have been 720. Yeah. So if I had never decided to reclassify it as a non-current asset held for sale, it would have stayed an intangible. I would have amortized it, and the carrying amount at April the 1st would have been 720. But I didn't do that, isn't it? I took the asset, I transferred it to non-current assets held for sale. It stayed there for the 9 months. I didn't amortize it for those 9 months. The value is now still sitting at 960. Now when I reclassify back, it has to go back at the lower of what it would have been, or the 700, which is the recoverable amount. And so now it needs to go back at the 700, which is the recoverable amount. And so therefore, I'm going to have an impairment, isn't it? I'm going to have an adjustment to write off the asset from 960 to 700, the 260, so that then I can transfer it. Yeah? Because remember, I had transferred it out of intangibles into non-current assets at 960. It had stayed 960 for the 9 months. At 1 April, it was still 960. Now I want to take it back. What do I have to take it back at? I have to take it back at 700. So I first have to write off 260 so that I can take it back at 700. Yeah? And the way it works is that I write off first and then I take it back. Whatever impairments, write-offs, whatever happen in non-current assets held for sale, isn't it? In my intangibles note, it would just be a transfer from non-current assets held for sale, 700. And then I'd amortize from there, over the remaining life. I don't think I even have. The new carrying amount will be 700. The remaining life, 2.25 years. They worked out the remaining life from the beginning. And the amortization would then be 700 divided by 2.25 for the remaining 3 months of the year up to June. And the 260 will be an expense in your P&L. Yeah? So that's when I have a reversal of a non-current asset held for sale back to PPE or intangibles. A change in plan. It goes back at the lower of what the carrying amount would have been, or recoverable amount. All right, so most of the time, just to recap, most of the time, there is an example here, but I don't think, this example is an example of a disposal group that's reclassified. But the rule is the same, isn't it? It's the same rule, so we're not going to look at that. So essentially, in an exam, you would be asked most of the time for these notes. Yeah? And in order to get to these notes, what you have to get to is you have to get to what is the number at your end for the non-current asset held for sale, which will be lower of carrying amount or fair value less costs to sell. What is the amount of impairment? And then you write out the note. So this note, non-current assets held for sale, or this note, disposal group. Very similar notes. Do you agree? To do the numbers, we need to do those calculations, the ones that you practiced. You practiced one for a single asset, and you practiced one for a disposal group. Yeah. However, there was one exam question, which I'm going to hand out now, where they actually asked you to do journals. And I know that you love journals. So I think it's a good idea, as the practice question for today, for us to do this question, which is journals. And the journals were 18 marks. 18 marks, required 1. Let me just pick it up. 102, 2012. Okay, so you'll see that the required asks you for journals. The journals are for 18 marks. Prepare the journals to record the initial classification of the disposal group on the 1st of February. So we're not going to do that last step, isn't it? We're just going to do the 3 steps. The 3 steps are depreciation, etc., to 1 Feb. Then step 2, let me put the steps down. Step 2, reclassify to non-current assets held for sale. And then, or in this case, it's a disposal group, isn't it? So reclassify to disposal group. And then step 3 is to remeasure. And when you remeasure and you do the impairment, I want you to do it to allocate it. So I want you to say whatever the impairment is, and I want you to take it to disposal group land, disposal group buildings, disposal group equipment, whatever, wherever it belongs. Yeah. And then they have an additional journal, which is tax, but I want you to just do this for me for now, and then we'll have a look at the tax journal. Okay. So 18 marks. Here's the story. It's quite a story. They manufacture and sell beds and bed linen to local furniture shops. The linen division didn't meet expectations, and they've decided to sell it. The following assets and liabilities met the criteria to be classified as a disposal group on the 1st of February. The aim was for the disposal to occur before the 31st of July. Fair value less costs to sell was 1290. The carrying amounts of the individual assets in the group were as follows. And be careful because they refer to notes below, 1 below, 2 below, 3 below, 4 below. But essentially we have plant and equipment. Plant and equipment both would get impairment. Do you agree? We have a share investment, which will be valued at fair value and will not get impairment. We have inventory, which is valued at the lower of cost or net realizable value and won't get impairment. We have receivables, which are valued at the lower of cost or realizable value, less bad debts, in other words. And we have payables, which is a liability, which also doesn't get impairment. Then they have the notes about the different items. So they say the plant was bought the 1st of May at a certain cost. It has no residual. It's accounted for under the cost model. The depreciation charge for the current period is already included in expenses. Assume that the carrying amount of the plant is equal to the tax base at beginning of year. The equipment was bought the 1st of May. Assume depreciation is already included. So these look like these were the correct values, isn't it, at that date? Let's just see the rest. The long-term share investment was purchased for 150 as an investment portfolio. Let's see what it's in here at. It's in here at 248. The fair values are the following. At 1 May, it was 248. I think that was beginning of year, perhaps. At 1 Feb, it's 260. I have to adjust it, do you agree, to 260? Because I have to adjust it to fair value at that date. Because that's how I measure investments, at fair value. On the 30th of April, it was also 260. The net realizable value of the inventory at the date of the reclass was 38. At year end, unsold inventory with a cost of 10 had a fair value of 13 and estimated costs to sell of 4. No entry has been made to record cost of sales. I don't care about year end. Do you agree that I don't care about year end? Because I've been asked to do journals at the 1st of February. So for now, for what I've asked you to do with this question, you can ignore this piece that talks about the year end. Additional information. This additional information you can also ignore. Because it relates to discontinued operations, which we will do next week. You can see it's P&L items, isn't it? At the very beginning of the lecture, I said to you that discontinued operations is the P&L piece, and non-current assets held for sale is the financial position piece. So that piece you can also ignore. And they ask you for the journals. For 18 marks, it should be a fairly easy, it looks like it's not too much work. It should be a fairly easy, doable journal. Remember, you have to start off by doing, it's not this calc. You have to start off doing this calc. Do you agree? So you have to start off doing this calc. This is your calculation. And then once you've done this calc, you can then do your journal. which is to do any adjustments to the assets. It looks like there might be just an adjustment to the investment property and maybe a write-off of inventory. I'm not entirely sure. I can't remember now. The depreciation, it looks like, is already all in, isn't it? Then we reclassify and we remeasure. But this is the calculation that you have to start with. Okay, I just want to move these ones. You can see that this is quite an old past paper.
What year was it?
2010.
October or?
It was May. What does it say? Does it not say there at the top? No. Okay, it's quite an old past paper. It was May 2010, question 3. Oh, it just says question 3, I see. Yeah, May 2010, question 3 is what it was. What I will do as we are we're going to work through past exam questions now every lecture because we're done with the assignments. So what we will do as we work through a question, I'm going to try and find older questions, nice ones that I think maybe have things that are worth doing. And then when I give you the past papers at the end for us to work through, we'll work through the more recent ones. So I'll probably give you about 3 years of past papers at the end. Maybe 13, 14, and 15. But I have past papers going back to like 2007 or even earlier. I have, what's the earliest past paper that I have here? I don't know. It just gives away my age. But no, I at one stage tried to get past papers going back. Look, I've got 2004, October 2004, May, June 2004. I wonder if I have even earlier. So PPE didn't change, isn't it? Forex changed. But the PPE stuff hasn't changed forever. If you go and look at those PPE standards, they've been there for a long time. So for this one, the PPE stuff, all the PPE stuff, intangibles, non-current assets, held for sale, it's been there for a long time. And the old papers would still apply. This one happens to be May 2010. So it is quite old, eh? 6 years. 6 years ago. Mm. It's up to that point, I think we can assume that. Yeah. Because we wouldn't have depreciated plant after that date, so yeah. So I think we can assume that it's up to that. It's not very clear, hey, it could have been a bit clearer. The reason they gave you the yeah, I don't know. We don't. The reason we have that depreciation, yeah, I'm not quite sure why. They give us cost. You can recalculate it, I guess. Can you? No, we don't even know what the percentage is. Yeah, we can't. The solution is on the back. Usually the solution is always on the back of what I give you if it's a short question. So you can have a look if you really are stuck, but I'd like you to try without looking. Okay, let's have a look. I think it was pretty straightforward, right? They gave you the balances, so really, it was quite easy to do that initial journal, the reclass journal. You'll see that what they do in their solution is something that I don't really like. They mix the journals. This journal here, to increase the value of the investment with the fair value adjustment of 12 to get it to 260, should have been your first journal. Yeah. Remember I said journal 1 is to get your carrying amounts to the date of the criteria. They had said to you that they'd already put through the depreciation on the plant and the equipment, so that had already been done. When we look at the investment, we needed to take the value from 248 to 260. Do you agree? So that 12 needed to be put in. And then the inventory, they said to you the net realizable value was 38. It needs to be in at lower of cost or net realizable, so it stays in at 24. Okay, so the only entry that we needed to put in to get us to that date, to 1 February, was this adjustment to this investment, and that should have been journal 1. Okay. Then after that, we do a journal where we debit. What's happened to all my pens now? Where we debit. Here it is. We do a journal where we debit disposal group. And the disposal group is going to be debited with the net number, isn't it, of that first column, the reclassification. The net number comes from cost of plant and ACDEP of plant. They gave you the carrying amount, so you just had to split it. Cost of equipment and ACDEP of equipment, which was given, agreed. Cost of the share investment, or fair value of the share investment. Cost of the inventory, cost of the receivables, carrying amount of inventory, carrying amount of receivables, carrying amount of payables. Yeah? And if you take all of those numbers all balance back to this disposal group balancing figure of 1320, which, if you had done your workings the way I said, was your first column. Do you agree? And that's the big journal. The big journal is to get all your assets out of where they are into this disposal group, or this non-current asset held for sale. The second step was then to do an impairment. Your impairment works out to be 30,000 Rand. You all got that? 30,000 Rand. So the impairment is 1320, which was Calc 1, less the 1290, which was given. And so the impairment is 30,000 Rand. The impairment can't go in terms of allocation, right? The impairment of 30,000 Rand over here can't go to inventory, can't go to receivables, can't go to payables, can't go to share investment. Yeah? It doesn't go to liabilities, it doesn't go to current assets, and it doesn't go to assets carried at fair value. It goes only to, therefore, the plant and the equipment. And so you're going to allocate this 30 on these numbers. The net, this 765 and the 265, isn't it? And so this is the apportionment that you should have got. 22,500, 7,500. That's what you got? 49. Two. Oh, you forgot your payable.
Oh, okay. Oh.
The 19. You forgot your payable. Yeah. If you took 19, you would have got 1320, and 19 is your difference on your impairment, isn't it? Yeah. Okay, so remember the payable is a credit. It makes your number smaller. Okay, so there's your impairment of 30. We allocate it between the plant and the equipment based on the carrying amounts. 22,500 and 7,500. And then the last journal I said to you we were going to look at quickly is Deferred Tax. Deferred Tax. It's a small journal for deferred tax, and all it is it's taking the impairment and multiplying it by the 28%. Yeah. Why is it deferred tax? Remember, we're impairing plant and equipment. SARS won't allow you any more deductions on plant or equipment. What SARS will do when you sell it, they'll give you a scrapping. isn't it? A scrapping allowance. Or they'll give you more wear and tear, or whatever it is. Or they might even have a recoupment, I suppose, depending on what those carrying amounts are. But there's the deferred tax. It's just the tax entry on the impairment. So it's, remember, the impairment went into our P&L. It was a debit, so we credit tax in the P&L. Yeah. Remember, the tax entries always go the opposite way. So here's my P&L debit over here, and then here is my P&L credit for the tax, 28%. 18 marks, eh? There's a lot of marks. What? The journals? Yes, it's also fine. So journal 1, you could have done individual journals. Yeah, that also would have been fine. Yeah. So, in fact, definitely the one that I had in green highlighted, I would do as a separate journal. And then if you wanted to do individual journals for each of the items, you could also do that. It doesn't matter, as long as it's the same number that you then balance to. Okay. So we will practice some more disposal group questions. This was the only one that I recall being a journals question. The other ones are usually disclosure questions with a note. So we will get to practice some of those later in the year. Next week, we're going to continue with IFRS 5. We're going to look at discontinued operations, the P&L piece. Tomorrow for that, huh?
Thursday.
Tomorrow's Thursday.
Yes. At 10:30.
Yeah.
What do you cover in this topic?
That's 3701. I'm going to do, it's 3701, right? I'm going to do optimization.
And
Optimization.
I think the special order as well. Or is that for next?
Well, I'm going to do optimization first and then relevant cost of the special order.